Okay, welcome everybody to another Learn It Live webinar for how to day trade Forex during volatility. Now, it's a very special one this week as part of our weekly webinars for April. We are now joined by special guest Chris Weston, so head of Global Research at Pepperstone. So very exciting one. Hello, Chris. Hello, Tyrone. How are you?
Good, thanks, mate. How you going?
Yeah, very good. So firstly, Chris, do you want to tell everybody a little bit about what you do at Pepperstone and your trading career?
Yeah, I head the research team here at Pepperstone. I sort of look at multi-asset markets really, and I look at it from a sort of a fundamental view, like a top-down view, looking at what the big picture situations is, look at what markets are moving, and yeah, there's a whole factor involved in things, looking at volatility, looking at the expected moves in markets, which can really help with things like risk management and position sizing. And then I'll look at the technicals, the price action, those various factors. So there's a whole process. But yeah, I'm really in charge of just trying to give ideas to people, give people insights into what's going on in the world that's slightly different from what other people may be giving. And I come from a background of started my career in a US bank trading equities, and then I moved into rates trading for Merrill Lynch. I've traded currencies for a Swiss bank. So yeah, I've been in the institutional and retail trading for about 20 years now. So yeah, hopefully I can give some decent insights for you tonight.
Excellent. And Tyrone, we are always on the webinars, but we don't talk much about our background. So how did you start your beginning in trading, and what have we been doing recently?
Yeah, well, my career in trading started with beginner's luck, really, on holiday. Ended in disaster pretty much a week later, but it certainly started out good. But yeah, we've been doing this a long time now. Yeah, touching on 15 years. So it's certainly been an interesting road. But yeah, the last few years in particular have been fantastic for us. We've been able to build this community of traders, and yeah, everybody's really getting involved. So it's really good to have everybody on tonight, all of the regulars and also some new ones. But look, take this opportunity, everyone. If you've got any questions that that you want to fire off at Chris in particular, because he's got an insight that is really in depth on a lot of the the fundamentals. So yeah, feel free to tap his brain on that one, and fire off the questions in the question chat room, and any of them that we think are relevant, we'll bring up live, or we'll do our best to answer them as we go. But try to take advantage of Chris being here, because he's a wealth of knowledge, and it'll be really good to cover a few of the different aspects of trading that we don't cover on a weekly basis.
Yeah, absolutely.
Sorry, can I just confirm that everyone can hear me okay? There's a couple of people saying that my voice isn't particularly clear. Can you just confirm that sounds okay your end?
I hear you fine. Maybe just slightly quieter than us. But if you just talk a little bit more into it, yeah.
I can hear you fine, Chris. And look, we're getting a lot of yeses, so I'd say it's all good. Maybe for those who are hearing a little bit, sort of jittery, maybe just check your internet connection, because it seems that most people have got this one with pretty good sound, so it should be good.
Okay, all right, so let's just quickly talk about the Telegram groups. Obviously, the Pepperstone Telegram group is an amazing wealth of knowledge. There's always a bunch of information in there, and pretty much every day there's like a top 5 kind of daily things you need to know, and all sorts of interesting articles that Pepperstone are putting out. Some of them we write, many of them Chris writes, and some great videos. So please join the links. We'll pop the links in the chat right now, and make sure if you have a Telegram, get on the Pepperstone Telegram group, and also you can join the FX Evolution public chat, which is just where traders can kind of hang out and have a bit of a discussion. So it's a really good synergy between each one of them. So feel free to join these. I think during this time, especially with high volatility coming back in through oil, as we've seen in the last kind of 48 hours, it's a great time to get involved and make sure you have news at your fingertips. So join both of those Telegrams as soon as possible if you are interested. So what are we going to be covering today? We're going to be looking at live intermarket analysis, oil, S&P 500, etc. Chris is going to be deep diving into a bunch of that stuff, and then we'll look at some technicals. It's going to be great. A dive into obviously US dollar index and major currency pairs such as the Aussie US dollar, Euro US dollar, and a few other US dollar crosses, and we'll talk about cross currency analysis. And then, of course, how to identify a trend bias and develop your system during times of volatility, very important. And then a live Q&A. So you have a unique opportunity to ask questions today, and Chris will hopefully be able to answer some of the best ones. So we'll do that.
Yeah, and before people start asking, I'll just quickly mention, yes, this webinar is definitely being recorded. It will be on the YouTube, the Pepperstone YouTube channel tomorrow morning, okay? So if you're having a few issues tonight, don't worry, the replay will be up tomorrow on the Pepperstone YouTube channel.
Okay, quick risk warning. The information contained in today's webinar is of a general or generic in nature and is for educational purposes only. The information does not take into account your personal objectives, financial situation or needs. So please consider it only general advice. We are not giving any tips or anything like that today. Okay, Chris, so I'll hand it over to you before we get any further in, and I'll just quickly give you the screen share and you can show everybody what you have ready for us.
Well, thanks, Jen. So you can see the chart. So just before we go into the various markets, so I just want to sort of set the scene, just to say where we are, because you know what, 22 days into the month of the year, and it feels like we've had eternity this whole year. It's been absolutely crazy. I mean, it's an incredible time to be alive, not just in real living, but also in financial markets. And you know, we're through it at the moment. So, you know, I think we've got some huge numbers in the room today, and I think that's likely to continue to be this answer: what the hell is going on, and where are we going to go? And you know, give us some little bits of to this jigsaw. So I just want to set the scene quickly before we go into the markets, and then you guys can you know, go into sort of how to trade them and the technicals around that. So it should be a nice little 1-2 combination. But I just want to start with yeah, equity indices. We've got a lot of clients here who are trading indices, and they've got a really big impact on FX markets as well. So I just wanted to set the scene on this one, just looking at where we are in terms of markets. You know, ASX down 21%. If you price these markets in US dollar terms, so we're comparing apples and apples, you can see we're down 29% on the ASX 200. You go into the S&P, down 15%. So 15% for the year today is not particularly too bad. So we'll talk a little bit about why those markets have been outperforming. European markets are down hard, but they've come off their lows in terms of what's going on in the market. So their lows there as well. Let's have FX markets. Let's see how we've done sort of year to date. Well, in terms of year to date, in terms of major currencies traded against the dollar, we've got the South African rand down 26%. The Brazilian real down 24%. You've got these really high beta currencies obviously losing a lot of their value. No real surprise given what we've been seeing in the crude markets there. NOK, obviously a big one there compared to, you know, obviously big Brent exporter. The Antipodeans down about 10% apiece. The yen, the best performer so far. So obviously that big drawdown we've seen in financial conditions, equity markets going under pressure. You know, that yen continues to be, you know, one of the big places to be, as well as the dollar in times of risk off. How have we been low in the last month? Let's just sort of set the scene. You know, better times though. The risk currencies have obviously done a little bit better there. The NOK is up 10%, the Aussie's up not 10% as well. So we've seen a little bit better times recently, but yeah, certainly down year to date. What I like to do is understand what the market's trying to say in terms of volatility. You know, what is the implied volatility in the currencies? That can give us a good perception, not just of the expected movement, which is really a key for just not understanding how far away your stop loss is and how much risk you're taking, but also your position size as a consequence as well. So if we go into here, we're looking at 1 week implied vol. So this is what the market's anticipating, you know, in terms of potential movement. And for people out there who are trading currencies, the South African rand still has the highest implied vol, 24%. It's pretty big. You know, if you're trading the rand, you're going to expect some massive movement. Aussie dollar, 15%. That's pretty big when you can put it into a sort of 2-3 year range. So these markets, they still have very big expected moves to play through. For people who are not adjusting their position size because of the expected high moves, then, you know, that's something that you probably need to work on, in my opinion. The euro is something that we'll be touching on, because obviously it's a big component of the dollar index, and the implied volatility is sort of down at 7.6%. So you can see when you get down to these currencies, the implied volatility is lower. So for people who like a bit of movement and are prepared to adjust their position sizes, these are the currencies that you're looking at there: the Aussie, the Kiwi, the rand, Brazilian real, and the CAD to an extent there as well. So we'll just consider that when we go into what we're talking about with FX markets a little bit later. So just imply what the market's expecting of those sort of high beta, high movement currencies. And then of course, the one that's really been encapsulating everyone recently, let's go into the commodity markets. Okay, so we've got NYMEX crude, the June contracts down 81%, currently trading at 11% at the moment on the June front month contract. Brent price is down 73%. I think we're going to spend a lot of time talking about the oil markets there. Some of the ags, down a little bit less, but certainly you've got some moves coming there as well. So you set the scene in terms of what's going on. We'll touch definitely on the commodity markets. But in terms of FX markets, we've seen better days for some of these risk currencies, but overall the whole year, we're certainly down. So hopefully that sort of sets the scene. I want to touch a little bit now as we get into the webinar about one of the big questions that I'm fielding from a lot of clients. I'm sure a lot of people out there are trying to understand exactly what's going on with this massive disconnect that we're seeing between the real economy and also what's going on in financial markets, certainly equities and also corporate credit. I love this chart. This chart tells me just exactly what's going on in the data. A lot of people are saying, markets fell, 35% on the S&P, so probably pricing in a lot of bad news, a lot of bad deterioration in economics. But this one here is the Citigroup Economic Surprise Index. We're looking at the disconnect that's going on between the real economy, fundamentals, earnings, and economics relative to where we've been in that stock market. And what we can see here is the Citigroup Economic Surprise Index. This is important for me because what it does is it actually looks at the data, how it's actually come out relative to expectations, relative to the consensus. And we can see here that the data has not only been deteriorating in the US, but it's actually missing by quite some way as well. And that's been one of the reasons why we've seen such high volatility. It's been impossible to forecast. Look at the global one there. We're just really collapsing there. So data is coming out much worse than expected, but it's also deteriorating quite sharply as well. And that says to me, why is the stock market doing what it's doing? Well, let's have a look at what's really driving this and what's been driving that. Wait for this to load up now. Okay, so the main driver of risk assets and risk really since this point in the low point on the the sort of latest March, 24th of March, which I've got the S&P on the lower pane, has been the moves from central banks and the liquidity that's come through markets. If you have a look at the Federal Reserve's balance sheet that we saw on the 26th of February, you can see it has absolutely skyrocketed. By the end of the year, it's probably going to be closer towards $9 trillion. The excess reserves that this has created in the system, which generally are perceived to come back into financial markets, have increased to about $2.6 trillion. I could go back and show this how this works, but you can see as these excess reserves increased, the Fed's balance sheet started moving. Of course, you can say the RBA have done something similar, the Kiwis have done something similar, the ECB as well, but markets responded in kind. High yield credit, the spreads collapsed. Equity started moving, and we obviously saw this big move. Now we'll talk about the technicals on the S&P later on, but you can see that we've broken down a little bit. But the market clearly responding to liquidity measures playing through. So that's been one of the big drivers of equity markets. What I think is really important, and I'll just touch on this before we go into the one more. I've got two more charts, and then I'll hand it over to the boys to sort of go into what we've seen there. I think this chart is now really incredibly important. Okay, so what we've got here is the S&P, which is the orange line here, and you can see that it's had that move up, which we just showed there. Well, I think when the Federal Reserve were coming out and doing these very measures, buying high yield debt, buying investment grade credit, buying pretty much everything you can have with the exception of equities at the moment, is they wanted to create higher inflation expectations. They wanted people to believe that prices were going to go up. Now you can see that in these break evens, the blue line. This is a tradable market product that financial people can trade in institutional banks that actually expresses a view on where inflation is going to be averaging over a 5-year period or a 10-year period or whether the asset is. But you can see here that 5-year inflation expectations moved up aggressively here, and their 5-year bonds anchored. So that means that real yields moved lower. So when you're talking about deposits in a bank account, you always think about real returns, inflation adjusted returns, and that's what bond investors do as well. And this is really important for the dollar. It's really important for equities because lower real yields, lower inflation adjusted returns are really positive for risk assets in general. It's really negative for the dollar. Higher real yields are very good for the US dollar, and that's been one of the key drivers there as well. But you can see when inflation expectations moved sharply higher, look at the S&P, bang, up it goes. Bond markets are staying firm because the Fed are buying pretty much every bond there is out there. Equity markets love that. Now what we're seeing is these inflation expectations are rolling over. The question is will the S&P follow? Will it converge? In which case, is there going to be downside to the S&P, which you can see potentially it's going to play catch up? And if the S&P is going to fall, potentially that could mean that we're going to see higher volatility in FX markets and a stronger US dollar as well. And I want to touch that.
Just quickly, Chris, is any with that last chart? Just is it possible to push it out even further in terms of the history that you've got on it? Because obviously there's a lot of synergies there between those three.
Yeah, we can go back, but let's go back to 2007, see if there's any correlation. It's a bit messy to be. I mean, you got to break. The reason I put into this area.
Yeah, it's probably it becomes like way more synergistic recently. Yeah, I see what you mean.
I mean, the reason I'm doing it here is because the Fed are now trying to engineer higher inflation expectations. They're doing things now which they've never done before. I mean, they're literally throwing, they're making this up every day as they go along, and the bond market. But what's important now in this case here is that inflation expectations are rolling over, and we're concerned now that equity markets are going to potentially go down as well. So we'll look at equities in a moment. You guys can do your thing. But there's one more chart that I just really want to catch up with. When we're talking about the disconnects that are coming through in markets, we've seen the disconnect now between that higher equity price, which has been boosted by Fed central bank liquidity measures, which we've tried to prove. But now with inflation expectations rolling over, we want to sort of get into the oil markets. Now, one chart that I think is let me not bring that one up. Let me get another one up. One chart which I think is absolutely key is the oil futures market, right? And I think everyone's seen what's been happening in the oil price recently. But what I want to do is I want to take this out past all the kind of craziness that's been going on over the last couple of days, the last 3 or 4 days, where everyone's worried about what's happening in storage. There's too much oil being produced, not enough places to hold it. You're going to have to pay certain producers to take the oil off your balance sheet. Let's go further out the futures curve. And let's have a look at oil in the 5th month. This is the October contract. So we're going further into the future. It's a lot of the producers will probably look more further down the line at the 5th contract. Now, this takes out a lot of the craziness that's going on right now, but it looks at future demand, supply-demand dynamics. And this is really important to me. It gives a much cleaner picture about how the world's perceived in the future. And what we've got here is the white line, which is the October, June oil contract. And you can see it collapsed really from around January time. It took a while for the S&P to catch up, but when it did, obviously it caught up. In March, we then saw the oil price have that nice rebound, and now we've rolled over as well. The difference between oil and stocks is that they're not responsive to Fed policy. They can't be, they can't be buoyed up by what's been going on in liquidity, all these various factors. So this is a really pure look at how people see economics in the future. So we're talking about that disconnect between the real economy and asset prices. Well, perhaps oil is telling us something there as well. You can see it started a trend there, and you can see it started a trend now. The question we've got here is if the S&P is up here, and we've seen that divergence, and we've seen this price roll over, perhaps this is going to play catch up as well. So this is a really interesting one, and I want to bring it to you guys now because we've seen that disconnect between the real economy in terms of what we've seen for Citigroup economic surprise. We've seen stocks being buoyed up by liquidity and central bank measures, very artificial means. We've seen oil prices roll over. We've seen inflation expectations rolling over, and both of those have been a pretty good leading indicator for the equity market. So what are you seeing at the moment? For me, I see downside risks to the equity. I'm not calling an absolute collapse, but I just some of the forward-looking indicators that I look at the moment there. Between those disconnects, and I think there's going to be some solvency risk. Companies are going to fail as a result of what's happening in oil prices. I think people are going to see that economics. What are your charts telling? I mean, I'm interested to see from what you're seeing in the S&P and global equities to start, and we'll use that as a beacon then to move into sort of into FX markets.
Yeah, absolutely, Chris. So I think, look, a lot of the correlations, as you said, the disconnect is real, and we're even seeing it in certain indexes in the market. So if you obviously most big Western nations have begun some form of quantitative easing or at least stimulus packages in response to what we've recently seen in terms of the COVID outbreak. But here we've got well, firstly, I just guess I'll touch on spot crude because, as you said, it's an absolute epic collapse in terms of spot crude price. And for anyone that hasn't necessarily, well, actually, I've never seen spot crude go this low, even in my 12 plus years of trading. So this is definitely a time that you need to pay attention to. And I think that's on the risk side as well as considering what can happen. Always expect the unexpected. Obviously, a very famous kind of quote, but that's what we're seeing with oil. If you asked anyone 2 months ago, 6 months ago, whether oil could go to a spot price of $7.63 a barrel, most people would say, no, it's not possible. And that's the problem that sometimes for people, you have to expect the unexpected. Things do happen. And unfortunately, it has happened to some people where they've been against this. But I think the biggest thing you want to do in these markets is follow the trend and wait for proper confirmation that new trends are intact or moving. Firstly, I'll just quickly bring up this copper chart. This is a copper monthly. As Chris brought up, many different things can show you an economic health. Copper's one that in the past has definitely performed poorly during, I guess, financial crashes or economic uncertainty, and then performs incredibly well coming out of that economic uncertainty. And that's because it is used in many industrial in a lot of the economic activity in the world. So we can see copper has definitely been in a short sell, and it's recovered somewhat since the stimulus in the American market. But we've got some key supports here, Chris. We've got this kind of $2, $1.96 as a support, and then of course we've got the GFC supports. So expect copper to a degree to follow US 500, and if it gets past these levels, and I think this one's going to be an incredibly key level for it, this 196, copper could definitely fall all the way back to the GFC lows. And at that point, you were probably seeing the S&P coming with it to a degree as well. So copper's one of those leading indicators that we do look at. Spot crude, some incredible moves. I'm actually going to load up over here and just talk about being able to read trend. So one thing that you want to do is read trend, and you want to read it as quickly as possible and as accurately as possible. One of those ways is by following price action or actually reading the price. So whenever you're considering trading in the market right now, you want to make sure that you've got a series of peaks and troughs, or higher highs and higher lows, as many people call it. So you want to see not only the base, so I'll just highlight this up for everybody. If we've got like a base formed, we want to see the market pull off that base and then come back down and then make a higher peak. So we want to see this price action, because this shows that the bigger traders or the people that are getting involved with the larger money are confident in the move up or confident in the move down. So we want to see troughs, peaks, higher troughs, and breaks of those peaks. And that's going to be an important thing. Now, an easy way of doing that, if you are not very easily able to read price action, is obviously moving averages. And we talk about these moving averages on this webinar all the time. The 20 moving average, incredible moving average used in the industry very heavily. The 50 moving average, make sure both of those are exponential, which puts greater weighting on the most recent candles, means it's a little bit more dynamic, and it's also better for these incredibly aggressive markets. And of course, the 200 moving average. So leave all of those on your charts, and what you'll notice is they'll act as not only helping you to read trend, but they'll also help you determine pullbacks in the market. So when things pull back to a 20 moving average, especially on a daily or a 4-hour, it means a lot, and that's going to be something you want to do. Another thing is going to be patterns. So we'll talk about these patterns and then talk about what could happen to the S&P 500. So here's just a quick technical analysis chart that we put together. It's free for all Pepperstone clients. Really, the essence of it is these kind of patterns are the patterns that you want to be looking for in these highly volatile markets. So things like symmetrical triangles, double bottoms, double tops, head and shoulders, channels, they're the type of patterns you want to see. So Tyrone will post that in the room and everybody can obviously grab that for free now.
Can I just, I don't know if you can still see, but I just want to show you this really quick chart of copper. But
Sure.
you go.
I'll just bring it over to you.
Yep.
Not yet. I'll put it over to you. Yeah, here you go.
I'll be 2 seconds. I don't want. This is going back to take the data out there. I don't know if you can get it on that, but you can see that we've broken through this long-term trend. We tested it. We had this kind of fake out around here, and we've come back. So I think that's a really key situation there for the copper. If the global economy is going to continue to deteriorate, copper's going to go down with it. And we've had this multi-year trend break. We've had the retest. We've had the rejection. You know, for me, that could be something that's very, very powerful. So we're going to be watching that.
Oh, absolutely. That's
most
exactly
definitely.
the same lows. Yeah.
Everybody who follows us, and I know a lot of you are in here tonight, you know what we feel about role reversal zones and retests of those key breaks. So that's obviously a very, very important level. The only thing I will just say on the technicals that we're talking about, just more in terms of oil more than anything else, just be mindful, and it's only because I've been asked this about 100 times today that a lot of people are seeing divergence on the big oil charts because of where it's at. The one thing I've got to say, and I know Thomas has already touched on it, but the most important indicator that you can follow during a time of uncertainty and unprecedented movements is price action. It is the most important indicator for many, many reasons. And I know you always hear us talk about that, but never more important than at a time when, like oil has been, it's going to a place that it's never been before. Nobody knows where it's at. But what everybody does know is the world will not function without it. Our economy will not recover without oil back where it needs to be. That said, everybody's trying to pick its bottom. Everybody is trying to say, well, you know, we know that it's going to be, you know, back in its potential heyday in the future, but when is it going to turn? We need to rely on price to let us know when that is happening. When we see price starting to form the higher highs and higher lows off these key levels, that's the real indication that we need to get on board. Don't take any, don't pay too much attention to things like MACD and, some of these moving averages that we're talking about when oil is at a place that it's never been before in an uncertain time. Technicals will not factor in that there are ships all around the world with oil that they can't unload. Until something changes from a fundamental standpoint, and globally that's going to mean a cut in production at some point in the future, and I'm assuming it's going to happen fairly quickly because they've got nowhere to put it. Until that starts to happen, we are not going to see oil start to rise, no matter what the technicals say. So just be very, very mindful that the most important technical indicator that you can use in times of uncertainty on particularly oil is price action. So pay a lot of attention to that.
So we'll talk about some scenarios now, but Pepperstone's introduced spot crude, which is excellent. And if you have a MetaTrader 5 platform or MetaTrader 4, please right click on your market watch window and then left click on show all. And then that should show you all the extra pairs and things that Pepperstone have added recently. So you can see here spot crude. So let's just talk about price action, Ty, just from a pattern perspective before we hand it back over to Chris to talk about some currency stuff and bonds. This is the kind of thing that we're actually looking for generally in markets in terms of stabilizing effects. Now, this is obviously a weekly, but the same type of thing on the smaller time frames. So if we were in, let's say, a 4-hour chart, and the 4-hour chart was doing something like this, which is a double bottom pattern, and it broke past that intervening trough, this is the kind of opportunity to the upside that you're looking for. You need the price action to consider a low, and then usually it will retest the low, and then if it retests the low and finds support and the market buys it back up, that shows you that the market has considered the level, it's tested the level, and market flow or money flow is coming back into the market towards the bullish side. Conversely to that, if we drop down into the smaller time frames, this is an incredibly aggressive, obviously, sell-off even on the 1 hour. Usually the market at some point will want to come back up, and it will like to test something like the 20 moving average. And we can see here the 20 moving average has acted as dynamic resistance for quite a while on this pair as it's selling off. So if the market came up here and we saw something like a shooting star candle or an engulfing candle or a double top or head and shoulders, any of these kind of patterns at this point, again, that may be an opportunity to potentially look to further shorting this kind of pair. And that's the kind of thing you're doing as a technical analyst. You're not going to have too much bias, but what you are going to be doing is looking for technical reasons in either direction that are based on price action and based on more than one reason. So Chris, I'll hand it back over to you. I believe now we're going to be talking a little bit about, well, I'll get into actually the stock market just quickly and talk about some currency stuff. So S&P 500, we've got some key levels up here. We've got the 2650 zone, the 2850 zone, and the 2450 zone, and then of course the previous lows. So the 20 moving average has held in terms of being a support level. Chris had a bit of a trend line there as well that you could see, which is also holding it. If it gets through this zone, expect the market to potentially sell off into the 2650. This will be a key area of role reversal. Many traders will see this based on the daily. Obviously, it gets through this level. 24 kind of 50 is going to be the next key level of support. And if it gets through this level, potentially a retest of the lows. So that's from the bearish side. The bullish side would, of course, need a close above this zone, and then probably the 200 would act as some kind of dynamic resistance. So if the bullish side would be a break of this previous highs, at that point, when it probably comes back and retests, you might see a 2050 cross to the bullish side, and then that could mean further stimulation in the economy, or we're coming into a recovery phase. So we'll have to see what happens over the week, but there's some key zones for everyone to look at in terms of technical analysis. So Chris, have we got you there?
Yeah. Can you hear me?
Perfect. Yep. So I'll transfer it over to you, and then you can have a talk to us about, I believe, currency and maybe some bond stuff.
I'm just going to sort of jump in with a couple of things that I think is really important. Just in terms of, you point out the move there in the S&P, but I just think it's really important to look at what's implied in terms of movement. For me, this is just so important for your money management and for your risk management. And if you look at the VIX index, which we offer as a futures market, but we price it off the futures, but if you have a look at the cash, at the moment it's pricing 43%. So that's an annualized figure. We can break that down into daily moves. And what I can do is if you divide that by effectively 15.9, you see 43%, you can get a daily movement in the S&P. So the expected movement at the moment on a daily basis implied by the options market is 2.9%. So if you're dabbling around in US equities, you can use the VIX index to understand the expected move up or down. Volatility is directionally agnostic. It goes up and down. So you know that there's going to be nearly a 3% move on any given day. You can work out the potential points. And if you're trading off daily charts or 4-hour charts or anything that's not scalping, you can have a pretty good understanding about what the expected move is. Now you can leave your stop loss further away than what the implied move is. And of course, if you understand that the market's pricing in a 50-point move, you're going to have your stop loss somewhere further than 50 points. I think that's really interesting. What's also interesting is that the market is not out of the woods. So we've had a nice rally, and we're well off the highs of implied vol there, but you can see we're somewhere halfway between, but we're certainly not down here. What I also look at is the differential, and this gets to be a bit more complicated for people who are not options traders. You may not be too au fait with this, but I'm happy to talk to people afterwards about what this all means. But the options market is great because it's based on math, right? Everything is based on math. It tells you everything's quantifiable, and it gives you a really clear understanding about sentiment. It's a different way of looking at sentiment. I use it all the time for FX markets. I put it out in my commentary, but you can see here that the 1 month implied option, 1 month volatility of call optionality for the S&P. So 1 month 25 delta call options, which obviously give you the right side for upside, relative to the implied volatility of put options, giving you downside. So puts are trading at a 15 volatility premium. That's come back from where we were. We got down to about 26 volatility difference, which was absolutely extreme. We've never seen anything like that, even in the GFC, where people were just saying that the downside is so significant. And maybe that was a reversal. Maybe that was a contrarian indicator in itself, that everyone just got way too pessimistic. But what you can see now is that you saw that people buying call optionality, and that's rolled over now. So the fact is with this chart, which I think is really important, is that the market's saying we're still expecting high moves. We're still in a high volatility regime. It's picked up a little bit recently. but we're also now starting to see this roll over and people starting to bet by buying put options over call options. If this head is lower, it's going to tell me that the options market is starting to see greater downside risk. And I think that's really important for people who are trading indices. You know, look at the options market and see what they're saying. It can be a really good leading indicator, and it leads into some of the other factors that I've been talking about there as well. What I think then, given that we focus quite a lot on the S&P, is just I just want to bring up another chart. Bear with me.
Yeah, no problems. While Chris does that, yes, the volatility index, definitely one to watch. As Chris said, 40 is extremely high. If we actually took that chart out and we blew it up and put the GFC on there, you'll notice that it's incredibly high, even for the GFC. 40 is amazingly high, and 80 was, I think, an all-time high, wasn't it, Chris? I don't even think the GFC.
I want to show you the oil implied volatility overnight, because that's just insane.
Okay, oh, that's, yeah, they were talking about this before.
So what we've got here, and I'll bring it into the currency market, it's a really good little segue. So what we've got here is, I want to show you why the S&P is so important to me as a currency trader, because what we've got in this situation is we've talked about inflation expectations rolling over. We've talked about the S&P and potentially where that's going. But look at the white line here. This is the S&P, the US benchmark. And this to me is the central index, pretty much above everything else. And you can see here Aussie yen. Look at the close correlation that you can see between the two. So there's been a really strong correlation between what's happening in movement in the S&P and Aussie yen. For people who are trading the Aussie dollar, which I'm sure a lot of you out there are, you can see again what's making the Aussie dollar tick. Well, it's the S&P. It's this risk on, risk off thematic playing through. So what I want to do now is I want to have a look at the correlation between, you know, things like the Kiwi dollar. Look, it was very strong up until here. It's broken away a little bit here because the Kiwis now are looking to monetize and go down a full MMT path. And I think that's, so you saw that really strong correlation, but it's broken away a little bit there. Let's have a look at euro dollar. Yeah, again, you know, it was really strong. The US dollar was strong, but it started to move a little bit away, but it's, you know, you can see there. So what I try and do is I try and understand what it's trying to make currencies tick. And I think a lot of the yen crosses are very correlated to the S&P, hence why I think it's really important. But if you want to play the S&P at the moment, you can do it through Aussie yen. It's pretty much moving tick for tick, or the Aussie dollar, or some of the high beta currencies there as well. So I think this is probably a good idea then, boys, when we're talking about the dollar. Why don't you bring up the dollar index and show us what you think is going to happen, and I can sort of go into some of the fundamentals in a minute.
Yeah, sure. Let's see if the technicals will agree with the fundamentals here. I think they may. All right, I'll bring it over. Okay, should be able to see mine now. Okay, so bring up the US dollar index. Now, for anyone that hasn't done this, you should definitely have this as one of your daily checks. I stress it, put it on your charts. Very important to look at the US dollar index. I know I harass people about this, really important. So we'll just quickly go and have a look at a monthly just to start with. Everyone knows we like the top-down analysis style. So we can see some pretty key areas. We've got that kind of resistance that was peaked recently. And then we go down to the weekly, big chop in terms of where it has been. And then the daily, and probably the daily is where we start to really notice something happening, where a key zone is coming up. And if that breaks, I think it really opens a further move to the upside for US dollar. So previous lows, intervening trough here a little bit at this $100.96. And if it does break through this zone, it makes sense for it to probably try to go around the same distance as it did before. So if we take that distance, what we like to do with proving of technical analysis is, if that distance makes sense to the next move, it means the market's kind of thought about it and it's a good kind of technical setup. So break of the 196 definitely means US dollar strength, and we'd say that's potentially very strong US dollar strength coming through over the next coming days. We jump down to the smaller timeframes, and here we can see a bunch of, I guess, a bit of a channel kind of going on in the smaller timeframes, and then it's broken out and it's testing that zone. So if we broke that down to a 15-minute and lower, it's really come down and tested that previous kind of resistance is now being support. So on the daily, I think, is the best story here, Chris. And what are your thoughts just in terms of US dollar strength or weakness coming out of the oil problems that we're seeing in the markets?
Yeah, look, I mean, I think what's really important for me is what happens in the US dollar if real yields are going to go down. If inflation expectations fall sharply, which I pointed out, and this is something that I talk to people in my daily note every morning. If inflation expectations are going to fall sharply and the bond market stays firm, what you're going to see is people moving into the US dollar. People want the dollar in that situation. So you're going to get what we call rising real yields. So inflation expectations are key for currency markets now. If that continues to be the case, then you're going to see real yields rising, and that's going to be good for the US dollar. I also think that if you're going to see the S&P going lower, that's going to incentivize, you're going to see higher volatility, you're going to see that VIX higher, but you're also going to see the dollar strengthen. Those risk-on currencies, or those risk-off currencies like the yen and the dollar are going to work really nicely. If you bring up a chart of, you've got the dollar index there. For me, when I look at that chart right now, there's no, especially when I'm trading off daily or 4 hours, there's just nothing in there for me. It's had that big move, as you can see, from the 6th of March. You had that really strong move up in the dollar index going up until 103, and that was based on the idea that you saw financial markets going into a tailspin.
Absolutely.
Then you saw risk-on scenarios with liquidity coming through, and the dollar fell. So I think the dollar continues to be a strong risk-on currency. What you're seeing now is a market that has no idea what to do. It's very messy. If you were to put a Bollinger, you've got your 20-day moving average, which is moving sideways. If you put a couple of Bollinger Band on that, you'd see, that's probably going to be a good way to, that you put an RSI on that, you'd imagine that the RSI would probably be somewhere close towards 50. You got the 20-day moving down a touch, but if you put an RSI, I'd imagine it would probably be somewhere close to 50. Maybe, who knows? Let's have a look. Yeah. So you've got that mid-range. I mean, for me, when you've got the 20-day or some of the sort of shorter-term moving average moving perfectly sideways, and you've got the RSI mid-range, you've got a market that is really struggling to understand what's going on with the dollar. And as a macro strategist, for me, just trying to understand what's going to happen. Right now, the big debate is what's going to happen to the US dollar. If you can get your dollar call right, you're going to do pretty well in markets. Everyone says, oh, Chris, the Fed are expanding their balance sheets so significantly at the moment. Yeah, well, so's everyone else. Everyone's going down the MMT path,
Unprecedented.
Sorry?
I say it's unprecedented. Last time we didn't see everybody doing QE, did we?
Well, I've got a chart on that, but I mean, for me, it's right now, it's just, every man for himself. Everyone's expanding the balance sheet. Everyone's going excess capacity. And, no one's really selling or trading the dollar accordingly. Until we see the S&P moving up or down sharply, the dollar's not going to really move too much. And that's why I think trading some of the crosses right now probably makes a bit more sense, because euro, dollar, and dollar index are just moving sideways and looking for some sort of catalyst here.
Yeah, so again, usually US dollar index and euro US dollar are very heavily correlated to the point where you'll see them really work in a very synergistic kind of way. And if you notice, like, let's say a huge pattern on US dollar index, and then you go over to euro US dollar, you'll be able to potentially preempt a move because the US dollar index is broken past, let's say, a key resistance, and that would mean that the euro was going to weaken against the USD. It gives you a good technical kind of thing. And that's why we always stress put it on the charts. So I brought up this key level 1.08 kind of 20. That's been a support here on the 4 hour. Now we're not talking from a massive perspective, but it has tested it multiple times. And as we see on the webinar, and we talk about it a bit, we've kind of got that 3 touches here. And if it broke through there, it would be an interesting one to look at role reversal wise. This is going to be the next level of support. And then of course, a break of that level is going to open up these previous lows down here. So they're going to be the points to watch. And I like the fact that this support has been relatively strong on the smaller timeframes, just because it shows that if the break would occur, it could be more aggressive. And these are the 2 zones that are opened up by that one. Quickly go over to Aussie US dollar. As Chris said, it's very synergized with the S&P 500. Showing weakness on days generally when S&P 500 is weak, and showing a bit of strength otherwise, since of course the S&P has recovered. Here we've got this area, the 64 kind of 50. This has acted as previous support, acted as resistance, makes sense, and we're in this zone at the moment where it's really pretty range bound. If the S&P was to crash, probably the Australian dollar will also crash against the USD, and that would show in US dollar strength across the board. US dollar CAD, usually one very tied to oil, hasn't been as spiky as I guess we would think since the oil crash in the last 2 days, but it did break out, went up, pretty much hit this one kind of 42 zone. That was previous strong resistance. And notice how the market doesn't quite make it. Now, a lot of people will get greedy and they'll take their profits up here. We've said it time and time again, when you have an expectation in highly volatile markets, expect less. Between 70 and 80% of what you're expecting is more statistically likely to occur, isn't it, Ty? It's just happened so many times recently. Yeah,
it does. It happens a lot, and especially when the market's volatile. So you want to be, just bringing those expectations in, and and unfortunately, that sometimes means pushing your stop losses out a little bit further than you would ideally like. But as we all know, there's nothing worse than seeing your stop loss get hit because of a big swing, and then watching the market go exactly where you thought it was going to go in the first place. So you do need to, lift those expectations on the, bring them in to around the 70%. Or we found that 70% works quite well in volatile markets. I'm going to just take this opportunity to just let everyone know that if you are interested in Chris's Daily Fix newsletter and you want to sign up, I'll put a link in the chat window for everybody to see. So if you want to sign up to the newsletter, just click on the link and you'll be able to get Chris's Daily Fix. So for any of you who are interested in getting that information, that'll be right there. We've also had a lot of requests for looking at live market analysis. We're doing a few of the main pairs now, but we're doing our webinar, the FX Evolution webinar, at 9 p.m. tonight. So for anybody who actually wants to ask questions about the live markets and put some pairs up for us to have a look at, I'll pop a link in the window for that. It's a free webinar as well, so you can register for that one, because we're trying to focus more on the majors in this particular one to get as much information out there to you as possible. Or we've got the benefit of having Chris here with us.
Yeah, US dollar yen, Chris mentioned this is going to, yen definitely is a bit of a safe haven during times of volatility at this stage. 107 key level of support here, just saw that before and I thought it would be worth mentioning. And the last one before we hand it back over is gold. Look, we were talking about this pre-webinar, we weren't going to talk about gold, but it has come down somewhat and it's kind of broken past this, we've got a low peak, higher low, and then of course a break through that. So pretty key zone coming off a very nice new high. Bit of a scary weekly, but if we see where gold has been before, it's definitely been up as high as 1786 quite easily, and then many people are talking about gold potentially to 2000 this year, aren't they, Chris? I mean, I think you see it in many articles. 2000 seems to be that kind of key area that people want to get it to. But we did write an article for Pepperstone the other day, and we're talking about the synergies between volatility, the current stock market, and also the GFC. And gold does tend to perform relatively well over a recession and of course over high volatile times. So gold will be one to watch. All right, so you've got some other pretty good charts for us, I believe, Chris, is that correct?
Yeah, I just want to show you this one of gold, which I think is really key.
I'll bring that over. Yep. There you go.
So what we've got here is we've got the spot gold price. You can see the white line there. I should have put it as gold really, but what we've got is we talked about this idea of inflation expectations moving up, and when inflation expectations in the bond market, which is driven by central bank balance sheets and liquidity and all these factors, moves up faster than bond yields, it's what we call, you get deeper negative real yields. Okay, so gold is probably the best hedge against that. In a situation where all these central banks are expanding their balance sheets, all these central banks are basically making stuff up on the day, and potentially if the S&P was to go through 2300, you're going to see them start buying equities and equity ETFs and various factors like that. It's called the Fed put. The gold price is the best way of hedging yourself against that. And what we've got is this blue line, which is real yield. So this is inflation expectation adjusted bond yields. If you're a fund manager, and I used to work at Merrill's in the bond market, this is what you look for. You don't necessarily look at the return, you look at the real return. And what you've got here is that real yields have been moving up a little bit here. But let's have a look at let's invert this. See if this works. Okay, so what we've got at the moment is, because real yields have been moving higher, because I've just inverted this, you look at the correlation that you've been seeing, and this is not a bullish situation at all. What we've seen is when you're seeing this blue line moving up, what we're actually seeing is real yields moving down. So the inflation adjusted return that you're getting in the bond market is actually falling, and that's really good for gold. As you can see, the gold price, this white line, is moving higher. We've had this bottom. You can see they're moving in correlation. The concern I've got now is that you've got this disconnect here. So you've got rising real yields, which is why the stock market's falling, but gold prices are still high. We haven't seen a proper disconnect of this correlation for a long, long time. And that's what this is really fascinating for me. Gold price looks like it wants to go higher, but real yields are moving higher as well. And that doesn't compute. So that's something that we then go back to the technicals. We always look at price. Price is what is ultimately what, you know, I can come out with these funky, I can come out with these little weird and funky things that show me what I think is going to make things move, and that really plays into my risk assessment and my probability analysis. But ultimately, you trade and you react to price move. You set your stop losses and your risk management to price and expected moves. But right now, this is a red flag. And when I'm putting money, when I'm in the gold price, I like gold as a hedge against what's going on. But right now, the thing that's making me stop from going long gold is the fact that this natural higher real yields are actually moving against it. So that's something that right now, which I think is a red flag that would stop me going long, and potentially could actually be something that could cause it to go down. So when I'm looking at those natural correlations, right now we're seeing rising real yields, which is bad for equity markets. And in theory, because as I say, I'll flip this upside down, it should be bad for gold as well, because what we've been seeing, this relationship that's gone on for quite some time. So again, we go back to price, and price at the moment is obviously really firm. If you look at gold futures, for example, so that's the spot price, which is you know, obviously what we're looking at here. But if you go into the futures market, where the futures market's been crazy of late, there's been that massive disconnect between the spot market or the paper and then the futures market. You know, if you go into the futures market today, they're up 2%. We've got this kind of little flag pattern.
Oh yeah, there we go.
There's a little flag pattern happen. So my traditional fundamentals is that the gold prices probably could roll over from here. But we've got, you know, if you get a breakout of here, then you could see a really strong move. Obviously, you're looking at this channel, you know, looking at the flagpole, and that could extend right nicely through 1800 in that capacity.
It's also an inverse head and shoulders there, Chris.
Well, yeah, absolutely. Yeah. So you know, I think I wouldn't trade this right now, because one, real yields are moving higher, which has been bad for gold. But also, we'd wait for this to break. So as a guy who looks at daily charts, you know, I'd wait for this to break and to the upside. The other one, if I'm looking at gold on the technicals as well, and if I come back to the weekly chart, now I like weekly charts. Of course, you don't trade off weekly charts, but I love every Saturday coming in and just getting real perspective of what, you know, the ultimate structure, the rhythm and the feel. And what we saw last week, we saw this, you know, it's obviously this fairly ominous looking candle, and again we're waiting for the lower low, and on Monday we saw it trading lower, and it just hasn't kicked on. So you know, we're mitigating this obviously fairly bearish candle, which could have caused a big reversal. That hasn't happened, and actually price looks quite attractive. So we had this fake out of these highs in gold, and it looks this week like we're going to break and maybe close that. So this actually looks quite bullish to me. We certainly look like we're mitigating this bearish candle. The fundamentals are looking a little bit shaky in the short term, but price is looking quite good. So I'm just waiting for that break, and then perhaps I'll trade that. But yeah, it's a bit messy in terms of what we're seeing there in the differential between the two.
Okay, Chris, got some questions here from Graham. Is the case that governments like the US and Oz have been buying gold to fund quantitative easing? Is that the case, I guess? Is that
He
the
just
case?
corrected that with selling. He meant selling gold.
Okay. All right. So the question then will be, I think it's got to do with, yeah, is it the case that the governments like the US and Australia have been selling gold to fund quantitative easing? Have they been doing that, in your opinion?
No.
Yeah.
No, they've been printing money. They've been expanding the monetary base to do that. That's why you see, the cash balances and the monetary base expanding, and basically what they do in terms of quantitative easing is they'll create money effectively. Then they'll go to the commercial banks. In Australia, they might go out to your NAB, so your ANZs or whatnot. In the US, they might go out to Bank of America or JP Morgan, one of the big commercial banks, deposit-taking banks, and effectively buy US Treasuries or Australian government bonds off their balance sheet, which is why you see the Fed's balance sheet expanding. The bank then has a cash balance, which they put on their ledger. The regulator tells them they have to hold a certain amount of capital. Anything above that required level of capital is what we call excess reserves. So all these different banks are required to hold a certain amount of capital. Anything above that level, the market perceives as inflationary or potentially going into markets, which is why when you see excess reserves increasing, you generally see stock markets, reacting quite positively as well, because there's a perception some of that money may go into financial assets.
Okay, so I've got another question here for Chris. Frank is asking about how often a swing trader like Chris would look at the charts before and after opening a position.
Well, as part of the process, I look at charts all the time. I will never buy. I will have an idea based on what's going on in the world, and I've got a process behind that. But yeah, I'll never buy anything that's in free fall. I'll never sell anything that's in a roaring uptrend. I've looked at the S&P recently, and I've seen this near 30% rally. Have I wanted to short it? Absolutely. Have I shorted it? No, because it's in a strong uptrend, and you can see liquidity coming into the market through Fed actions. So I'm not going to fight a trend, and so I always look at the charts above everything else. So when you're trading highly leveraged products like CFDs, you need to put the odds in your favor, and following money flow generally does you fairly well. So I'm not going to fight a trend. I mean, there are people who do it very well, but for me, I'll follow the flow of capital. And when the market agrees with what I'm actually thinking about in my process, then absolutely I'll deal in that situation. But the market needs to be flowing the same way as I'm going, and then I'll latch onto a ride. That's kind of where I'm going with that in a short-term capacity. But yeah, for me, one of the most important situations is how you're managing risk and how you're taking positions on. So I will look at the options market very closely to understand what the implied volatility is. I know a lot of people in here will use things like average true range. So they'll look at, with the average true range, and if it's say 50 points, they might leave a stop loss 1.5 times ATR. And that's all well and good, and that's using realized volatility. But I like to use implied volatility because I think the market's looking forward at event risk, and it takes a bit of the realized vol in, but it gives you an expected move. And if you can understand the expected move, you can move your stop loss wider. And if you're going to move your stop loss wider because the implied vol's wider, then you're going to take a smaller position size. I think that's really important as well. So yeah, I think the reason I sort of go through all these various factors and look at all these charts is because there's no certainty in trading. All we know is that there's probability, and we can assess probability, and we do that when we're making our mind up for a trade, and we can make our mind up when we're in a trade as well. I'm just lucky because I have this Bloomberg terminal. I'm lucky because I spend my whole day doing this. I don't have another job to do. This is my job. But of course, when you're starting out, the best thing you can do is look at what the market's saying, and price tells you all about that situation. So I think you guys do a great job at FX Evolution teaching that. So, what's your view, boys, in terms of what I'm just saying there, and just looking at price above everything else?
Yeah,
Price.
I think you actually touched on a couple of very, very important points, Chris, that we actually preach week in, week out, and that's trading what you see, and sometimes leaving your bias at the door. Like, I totally agree. We've been dying to short some of these falling knives, but even though we believe that's where they're going, we will not get in there until we've got the market behind us. And we say it time and time again because it's one of the most important things in trading, I believe, and hearing it from yourself, obviously, as a fundamental sided analyst, it's really good to know that obviously it works on both sides, because it's very, very important to trade what you see and sometimes leave your bias at the door, as hard as that is to do.
I just want to bring up this chart of oil, because I think it's just so important for me right now when I'm looking at the oil market. I have a defined definition in terms of what markets I will be involved with, and yeah, because I trade off 4-hour charts and daily charts and get an oversight on from weeklies. I think it's important then to look at the implied volatility in the oil price at the moment. So what I've got here is the bottom pane, which you can see here, is the everyone. I think a lot of people here know the VIX, which is the implied volatility in the S&P over the coming 30 days. What this is another one from the CBOE, which I think you could probably go to their website and get this price. But it's the implied volatility in oil, WTI, over the coming 30 days. It's an ETF, so you could probably trade this. But you can see here that this is trading at 325, which they've only just started this in 2007. But the implied volatility at 325, to put some context on that implies a daily move up or down of 20%. I know 20% means less when you're talking about the numbers these days, but for people who are trading with, and not scalping the oil price, to be able to handle swings of 20%. I mean, today when we looked at WTI, it had a 25% reversal just today, and it felt effortless. If you can't handle and respect that level of volatility, that can be very, very bad indeed. So when I see the implied volatility spiking up, I don't want to be involved in that market. Some people love it, some people don't. But that's to me defining. I'll have a tolerance in how high that can be. I'll give you another example. If I look at 1 month implied volatility in WTI right now, you can see put volatility trading it. This is slightly different from the ETF VIX of oil, but this is actually in the options that are traded over WTI. You can see the implied volatility in put options, which gives you the downside in oil, in 1 month's time is 263, and you can see the implied volatility in call options is 133. So that means that the market's saying that in a year we could see oil price up 133%, or down 133%. But you can see that the call volatility is there. If you take the mixture of the two, this is what we call a risk reversal. So it's taking put volatility or call volatility and minusing put volatility. And what you can see, let me bring this up, is you can see the difference between the two, right? So it's absolutely collapsed. So people here are just betting in the options market that oil prices have significant downside. It just means, so my advice to you, if you're trading oil prices at the moment with Pepperstone or anyone, whether you're trading futures, whether you're trading ETFs, or whether you're trading our spot price, is just know that the volatility right now is absolutely crazy. You don't need me to tell you, but the options market's saying that there's going to be more of it, and just understand that your stop loss needs to be significantly wide enough, and therefore your position size needs to be absolutely minimal when you can have these reversals. So this is kind of part of the process. One thing we do, the thing which we do, like our primary job in trading is to grow the capital in our account, right? That's what everyone's trying to do with an account, trading CFDs or FX. Manage risk as a primary function. We try and achieve correct position sizing. So whether you're using the ATR, which everyone can get hold of, or whether you're using implied volatility, when you see that implied volatility is very high, or the realized volatility is very high, your stop loss needs to be wider, otherwise you're just going to get stopped out. And of course, then you need to do the main thing, which is adjust your position size. So just in terms of what we're doing on oil prices right now, it's we've never seen anything like this at all. And as I showed, if you go, it's not just what we're seeing in the near-term contracts where people are saying that there's a supply or a storage issue, there's too much being produced, and we need this to go out of business. So we need some firms to go out of business to see the lower amount of oil being produced. But it's even further out the curve into that 5th-month contract that I showed you, which has really rolled over as well. And I think that's telling us a really clear story about demand going forward. So, we could go into the June expiry in crude on the 19th of May, and we could see another situation where the crude price in the futures market goes negative again. And the oil ETFs have no idea how to even price that. And that's going to be something that's going to be very, very difficult indeed. So, yeah, just be. My advice there is just what we're seeing here is just absolutely unprecedented. And if you're not adjusting your position sizing because of the volatility, you could get lucky, or you could blow your account up pretty quickly. So that's the way I'm looking at it there.
Okay, Chris, I think we've got one last question here. Do you think there is growing pressure in emerging markets and their ability to service their US debt, in particular the oil producing exporting countries? It's from Matt.
Yeah, it's a difficult question because there was a lot of talk when hold on 2 seconds, I'm just trying to find the right chart.
Yeah,
there was a lot of talk when the dollar index was pushing strongly higher when equity markets were going down, that the emerging market trade was going to unravel very quickly. And the Aussie dollar got hit pretty hard on the back of what we were seeing there. But I haven't really got it too well here, but the Fed came out and issued a huge amount of swap lines with major central banks to be able to get dollars very quickly. And we were looking at funding rates, so dollar funding rates in cross-currency basis swaps, and also TED spreads and interbank market currencies, and how expensive as it was really to borrow dollars. And that collapsed when the Fed did that. But I think when you're looking at the dollar index and you're sort of trading up into sort of 103, yeah, people were concerned that the emerging market trade was going to unravel, and of course you saw emerging markets doing pretty poorly. But I don't think the Fed are going to allow that to happen. The Fed are the world's central bank these days, and they've made it pretty clear that they're going to support dollar liquidity in that market. The question is why the dollar hasn't fallen, considering the amount of swap lines that have come through in that situation, the amount of excess reserves. Why has the US dollar not fallen more than what it should have done? A lot of strategists were saying that was going to be the case. So yeah, I'm not too concerned about the emerging market trade unless we did see the dollar really ramping up again. But I just can't see that happening in this environment.
All right. Well, I think it's been a really good and insightful webinar for a lot of people. Seeing a lot of synergies there, Chris, between all sorts of things. I think in particular S&P 500, the synergy there, and a few different currency pairs, Aussie, etc., and of course oil and what we're seeing with that, and the repercussions of, I guess, as you said, stimulus can't necessarily hit oil right now, and that could be really one of the indicators of showing how poor, I guess, some of the ramifications are of this COVID-19 outbreak on the global economy.
Yeah, absolutely. I mean, as I say, inflation expectations for me are really key. Yeah, if you look at the S&P here, the S&P is central to everything. Whether you're a currency trader, whether you're trading other markets, the S&P is right at the epicenter of that. Because if that rolls over, given everything that we've seen from the stimulus to try and keep that supported, the Fed will stop that from happening, and they'll start buying equities, and that will just change the dynamic significantly. But look at this. What we've got here is the daily ranges on the S&P. You can see at one stage we were going up into sort of 9% intraday ranges, high to low, and that was where it was the peak of the crisis. So this is the S&P, the blue line here. You can see the sort of 5-day moving average of these the ranges. You can see the ranges were dissipating as markets were higher, and that was really bullish. I like to see that. I like to see the ranges subside. We see 10% moves on a range in a bullish market. bear market stuff, right? So you can see that the ranges on a daily basis were going from around 9%, and they've, you can see that 5-day moving average of these daily ranges, the S&P being the blue line here. What we then saw is we saw falling volume on the way up, and that wasn't particularly good. We're seeing poor breadth on the way up. We're seeing lower volumes on the days that we saw up days. And that to me is quite an important situation. So when I'm looking at the S&P, the quality of the journey from A to B, what's important now is that we are seeing, we saw falling ranges, which is positive, but now those ranges started to pick up on falling days. The volumes that we saw on up days were lower than the volumes that we were seeing on down days, and ultimately volumes were dissipating down. So yeah, we're looking at the market breadth, and that's falling. The quality of the A to B was quite poor, and now we're seeing inflation expectations rolling over. So it just wouldn't surprise me right now, as the market starts going into some of these economic reports, to see the rubber meeting the road. And a couple of dates that we've got on our diary. The first one is the 2nd of May. We're going to get the US ISM manufacturing numbers, and that's going to be horrible. Then the big one, the 8th of May, we're going to get the non-farm payrolls number. This is where the market's going to mark to market the understanding about what's going on in the real economy, because there's calls out there that we could see 29 million jobs being lost in that number. And this comes back to this disconnect. You've got the S&P, which was what, 15% away from an all-time high. You've got the Aussie dollar having a really nice rally from those lows. Yet we're going to see the US stock market, or the US economy, the world's biggest economy, with an unemployment rate somewhere closer towards 20-25%. We're going to see 29 million jobs being lost in that month. We're going to see the unemployment rate in Australia close towards between 8 to 10% in the second quarter. How does that situation reconcile itself? And that's why retail have just not chased this rally higher. How can you have a real economy that's just in such dire straits when businesses are going to fail and not everyone's going to get their jobs back, unfortunately, and you're going to see a lot of companies default in the next few months? How can you go and buy equities when you've got the real economy in that situation? So yeah, that's the disconnect that you've been seeing. And of course, price action is, if you take yourself away from that, you've probably done quite well because you followed price. But that's where we are at the moment, and I think we're starting to see that playing through in some of these risk assets now, as this data rolls in and shows just how bad it is and how many businesses are going to go under, and we've got a solvency issue. I think people are just sort of taking a bit of risk off the table, and inflation expectations are rolling over. So that's really, for me, as a top level situation, where inflation expectations go, where the S&P goes, where implied volatility goes. I think we'll have big impacts on FX markets, we'll have big impacts on gold, and obviously crude very much central to that as well.
Okay, thank you very much, Chris. Thank you, Tyrone. And look, hopefully everyone's enjoyed the weekly webinars so far this month. We look forward to coming next week and doing the final one for April. And of course, yeah, if anyone has any questions in the future, feel free to pop them in the room.
Thanks, boys. Great, guys. Thank you very much, Chris, and thanks, Thomas, for bringing us all of your insights. So hopefully everyone's enjoyed, and we look forward to seeing you in the next webinar starting in 45 minutes, or next week for the Pepperstone webinar, back to our normal time of 8 p.m. So thanks a lot, guys, and we hope to see you soon.
Thank you very much. See ya. Bye.